All right, let's do it.
All right. Hey, everyone. Hopefully you're having a good day. My name's Andy with the Finding Value Finance channel. I've got Scott with me. He's from the, was it Sow and Reap YouTube channel.
That's it.
We can definitely put that up there. If you're a fan of Scott, please check out his website. Go ahead and subscribe, Sow and Reap Capital. There it is. And we've got him back on. I've got some questions for him. A couple of questions are, well, it reaches across a couple of different things. And one of them is going to be one that a lot of people ask me, and they've asked other people too. And maybe I don't think we've talked about it before, but, and then we've got one that I'm going to ask him just because I'm contemplating what to do as well. And I'll ask that one first, since we can start there. If someone's deciding to buy right now, would you rather buy physical metals or would you rather buy companies, and why? Like, and there's no right or wrong answer here, and it's not supposed to be used for financial advice or anything like that. But for you personally, what do you prefer and why?
Well, based on my actions in the last couple of weeks, obviously the companies, because I've been selling down my silver to get some more uranium stocks and also shipping stocks. So yeah, I would say companies right now. I think market conditions are favorable for risk taking is what I'm thinking right now. Obviously not a financial opinion. I might be completely wrong, but that's what I'm thinking.
Now, this is going to be the other question tied into it, because I know you're going to give some answer, and whatever answer that was. And a lot of people ask me this, how did, with all of the information out there that people are giving on Twitter, like there's a lot of conflicting information. We've got yield curve inversion. We've got people very scared, recession this, recession that. Like, how come you're not afraid? Like, how can you just, I mean, your answer was basically you want to take on more risk. Why is that? How come you're not afraid? How come you're not worried about the next financial crash? Like, what are you either seeing, or what are you not seeing, or what do you believe or not believe about the markets?
Yeah, I think just based on history and based on, I guess, the historical data points. So if you look at any of the last crashes, it's always been a couple of years down the road since the first rate hike. That's one of it. Also, same with quantitative tightening. Obviously, we're getting quantitative tightening right now, but it's in the last cycle. It was 2 years after they started quantitative tightening that yeah, we saw a little bit of a flash crash. So I feel like the rotation of money, the one that you've highlighted in our previous interview that we did, I mean, the bond yields are, there's no sign of, smart money like jumping on bonds for protection. So, yields are rising, bond prices are falling, which means, they're not interested in bonds right now. They're not interested in safety. So I feel like all these factors are lining up for even maybe even a blow off top, so typically what happens if you look, I can just show you my charts. So let me show you my chart, what I'm talking about. Sorry, let me just get that right. And I can just quickly show you the chart of DJI. I think I posted this not so long ago. But if you look at the DJI chart, and just overlay it with Fed funds rate, and you can go back. You can go back so long with this chart, and it happens all the time. So if you go to monthly charts, yeah, here it is. So these are the periods where they raise rates, right? And exactly what's happening right now, we're raising rates. But what you see is like, yes, I mean, there might be a period of flattening out. So they've raised rates here, flattened out, Dow Jones did nothing, just went sideways. Obviously, there were a couple of, violent down days, which might have caused panic, but it never really resulted in a crash. And same with the 1993, they raised rates. Yes, a little bit of panic here. So if I zoom into this, you could argue that there was a little bit of panic here, just like what's happening now, but it just went sideways for about, what, 1 or 2 years, and then it went on an epic run. same here. Like they've started raising rates. Yes, a little bit of panic sell, a little bit of sideways movement, just like we're seeing now. And then a final blow off top. Same here. So started raising rates, a little bit of panic selling here, and then a blow off top before a mini crash of 2020. So right now, what I feel like is, yes, we've started raising rates. So we might see a period where we go sideways for a while the money's rotating out of, bonds and general equities into commodities. But what I think the more likely scenario is that we go sideways and have a blow off top rather than come down crashing. And this is just purely based on history. So, we've talked about delinquency rates, other indicators of crash, such as the delinquency rates and corporate profits, just using the Fred data. But, if you look at all those data points right now, nothing really points me to a crash, which is why I would favor risk taking, and I see dips as buying opportunities.
Yeah, so this past dip that we got today, this is 421 that we're taping this.
Yep.
I know a lot of people get afraid, they get scared. Hey, it's a big sell-off. Oh my goodness, we should be selling all of our assets or whatever. Like, how did you overcome, or what? I mean, is it the historical data that gets you to overcome these dips? Like how? I mean, I myself, like I can obviously look internal to myself and say, I am more afraid to not be in these stocks than I am to not. I'm more afraid to not be in them than I am to, or I should say, I'm more afraid. Yeah, I'm afraid to not be in them versus be in them. I'm saying that correct. Like I have to be in them. I have to be in them. And if it comes back down, I'll just buy more of it. That's been my mentality and my attitude. What's your mentality and attitude, and how did you overcome these dips? Like what did you do?
Yeah, I don't know. Like none of the dips have been significant enough for me to panic. So these are just normal market movements, right? So you have a couple of updates, strong movement up, and then you need to consolidate for a while. You need to pull back a little bit so that you can set another level of foundation for it to jump up again. So I'd be really worried if it was just going parabolic nonstop. If it was going up every day, that's when I'd get worried, because now then there will be a massive pullback waiting around the corner. But when you see these healthy pullbacks, yeah, I mean, if you're talking about any of the uranium names, so let's take for example URNM. Like if you look at the monthly charts, there's nothing wrong with them at all.
I know.
So I think in one of the interviews that we did previously, the chart that I like the most is weekly chart. When we're in a clear uptrend, as we are in uranium, I just look for higher lows and higher highs to form. So higher lows. So we put a low here, higher low, higher low, higher low, and we are, I think, on our way to form a higher, another higher low and higher high. So when we're seeing a series of higher lows and higher highs on weekly time frame, there's no cause for concern for me. These daily movements, I completely block out. I mean, I do post about it just to, maybe help others out there that might be feeling a little bit agitated. But, for me, like these are just normal market movements and nothing goes up in a straight line. And if it did, then that's when I would get worried, because I know that there will be a massive drop coming just around the corner. So, yeah.
Well, that's easy. And so basically, it's just knowledge of previous movements. It's knowledge of history that makes you comfortable holding through it. For me, I always look ahead. I look ahead out like 2-3 years, and then I look at the deficits, and that's where I look at inventory and deficits. So whenever like I don't even look at charts necessarily. I'll look at that and I say the market's still eating through inventory. I don't care what it's doing in the short term necessarily. I'm just looking for buy points out of the chart so I can load up. So that's the way that I view it. So my eyes are always on inventory and what kind of market balance do we have, and that usually resolves itself in inventory draws. So like right now with oil, it's like game on. I can't buy enough of it, even though everyone else is like, some other people are saying oil's going to crash. We've got this and that. It's like there's no way. I don't believe a single person who is saying that we're going to have a crash before summer with declining inventories, with the world like panicking releasing their strategic petroleum reserves on the market. I'm like, this is like double buy mode. And for some reason, I see it maybe perhaps different than everyone else. What's your opinions on like things that you focus on to ensure that you've got your analysis right or your mind right?
I think the biggest thing is, you know, just zooming out to monthly timeframes as well, and just seeing where we are, and really just coming down to, you know, if you do, we talked about the rotation of money between the three core markets, you know, the bond market, the general equities market, and also the commodities market. So if you zoom out and look at used oil divided by Dow Jones, for example, like we're really just getting started. Like this is where we are. Like calling for a crash now is like calling for a crash when Dow Jones was, I don't know, like in thousands. You know, yes, in nominal terms, it looks like it might have gone up a lot. But if you compare it to other markets, and if you just measure in real money as well, like, you know, used oil to gold ratio, it's still like hanging below here. Like it's really just getting started. So like, I just don't see it.
So here's another thing that I wanted to ask. So you're looking at all these ratios, you're looking at all this stuff. Like, how did you come about all this? Like, I mean, I did the same thing. And I find comfort in it because it's so easy to me to see it. What about other people who don't, like, they may look at this and they don't understand the chart. Like they'll look at it and they'll say, like, that's great, it's really low, but they don't get that comfort. Is it because we're looking deeper than the chart, or like how are we getting that comfort versus other people who aren't getting that comfort from it?
I think really it's just experience, like combination of losing a lot of money and making a lot of money. I think you learn from those experiences. And so I think that's probably the only way you will actually ever learn. Maybe. I feel like you need to have experienced the last cycle, for example. So when I bought, you know, a bunch of silver miners back in the 2000s, and I got my dad to buy, like initially, a lot of the stocks initially fell like 50%. You know, some of them he managed to get near the bottom, but a lot of them initially fell 50%. He was panicking, was calling me every day. I was like, just settle down, it's going to turn around. But you know, living through that, you know, having done, you know, minus 50%, and then and seeing it go up 10 times from where you bought it, or 20 times from where you bought it, after the initial drawdown, like having experienced that makes me a lot more comfortable that because we're in a super cycle in commodities, it's going to turn, like the money's going to flow in. Like I just feel, I don't know, maybe it's the experience, maybe it's the amount of research and due diligence that I've done in the sector, maybe it's my understanding of money flows between, you know, different markets in a rising interest rate environment, and especially backed by very strong mining cycles and demand supply pictures across the commodities right now. It might be a combination of all of that, but I don't know. I think experience is probably the biggest factor, I would say.
Yeah, and I mean, once you experience like a 20 or 30 or 40 bag or two, that like changes your mind dramatically. Because the one thing I'll say is, in order to get those types of gains, you have to experience drawdowns that are quite significant before it. There's just no way around it. And I know people are like, oh, well, like so for instance, news came out today about a 50 basis point rate hike, and it blew all these things to the downside. There was some chart setups specifically that I really like, that looked really good to go, but they sold off today. Like, what would you do if you were a newer investor? What would you do now? How would you take that news? Would you sell and be scared, or like how would you handle it? How would you handle that type of?
A lot of those interest rate related announcements, or whether it be anything like job data, inflation data, all of those things can be very much a knee-jerk reaction. So, you know, if you've been observing the market for a while, you'll know what I mean. So usually in the first couple of days, you know, they have a knee-jerk reaction to the news, and then, you know, a couple of days later, you know, it's very normal to see them get back to norm. So I mean, 50 basis point rate hike was something that was priced into the markets from long ago anyway. Like if you look at all the, what is this? CME Fed Watch, which basically is the predictor, what the market's pricing in basically. If you've been observing this, they've been pricing in 50 basis point rate hike for a long time anyway. So yeah, I just don't see it. I mean, it's already priced in. It's been priced in, if you look at this, so probability a week ago was 90% for a 50 basis point rise. Probability a month ago was 63%. So it was already priced in. So, these type of news events, I feel like are just knee-jerk reactions. Just best to ignore, block your ears and just ignore and, continue on with the thesis because it doesn't really change anything. If you're talking about 5% rate hike, yes, maybe. If you're talking about getting the nominal interest rate close to the real rate of inflation, maybe. But when your interest rates are so way below the rate of inflation right now, like your real inflation rate, your real interest rate is still negative, well into the negative territory. So I just don't see it. I don't know. I just don't see any crash that would arise as a result of this.
So if we were going to get a crash, if something was going to blow out and the banks were going to do it, like they were going to purposefully do it, wouldn't you see the interest rates where banks would be running into interest rates, declining interest rate or a flat interest rate at best?
Yep.
We'd see flat or declining because everyone would be jumping into it before the crash. So
yes, that's right.
Everyone
like we've seen every single time.
Everyone who's really worried about a crash, how come they're worried about that crash? And why are there so many people talking about a crash on Twitter and all these different things? Like what do we understand that they maybe don't understand? Like what are we missing or what are they missing that you think?
I think I just block out any of those noise because I just literally feel like they're noise. Because if you've been on Twitter for a while, I've only been on Twitter for like a year now, but like every single day there's some Twitter about a crash, an upcoming crash. Like I don't think there was ever a day without seeing some kind of Twitter around crash. And what did we do for the last year? It's like we saw no crash. So I mean, at any point in time, there's always going to be someone screaming about a crash. But my approach is just ignore that. And I often just mute a lot of people that are perma bears, permanently bearish on the markets. And what I just focused on is just the data that we've been talking about, the delinquency rates, the rate rise, quantitative easing, quantitative tightening, and how long it normally takes for markets to actually pick up on those tightening monetary policies. So you talk about housing starts. I think that's also a good indicator. So corporate profits, all these things, unemployment data. So you've got all the workforce participation rate. So when you focus on the data and not the emotions, which can be toxic in a market like this, because you just get so much drawn into some random person on Twitter that might not know anything about the markets at all. Or that have no proven record. So why would you rely on that when you can rely on data that's proven over, time and time again? So that's what I do. I just look at data.
Here's another thing that a lot of people will use as a counter argument to what kind of you're saying. And I wanted to get your opinion. Obviously, I'll give mine too. But they'll say something on the lines of, "That's great. You've got this data, and it all is looking, backwards." And then what they'll tell you is, yeah, but you don't know what's coming, and this is what's coming because mortgage rates are skyrocketing, and that's going to cause the crash. Or like how do you, when you look at data, how do you project it forward, or how do you like what do you do and how do you handle that? The use of data.
I would say historically data's always been leading. So data, you saw when we showed you the delinquency rates, for example. I'll have to share my screen again, but like data always shows up first.
So you're saying that there's some data that's leading and some data that is lagging, so to speak, perhaps, and you're looking at.
You could say that. Yeah. So, some of the leading data points could be like delinquency rates. So just because the mortgage, and we've talked about this before, but just because the mortgage rates go up, it doesn't necessarily immediately, or it never immediately results in foreclosure, right? Because what happens is the banks, have their books, right? So when you're talking about banks' books, you're talking about, 30 days behind, 60 days behind, 90 days behind, 120 days behind. And then eventually they go into foreclosure mode, and that takes time. So they've got all these hardship, management processes where banks can actually, you know, defer your payments, and you've got all these measures that are kind of enforced by the regulators these days as well. So it's never that, oh, I can't make mortgage repayment right now, I'm going to default right now, and banks are going to come after my home tomorrow. You know, it's never like that. It takes time, 30 days, 60 days, 120 days, and you might make some payments, and then it resets your time again by the requirements of the regulators. And then when it resets again, then your 30 days, 60 days, 90 days, whatever, it starts all over again. So I just don't. I think maybe it's because I've worked at a bank before, that I am familiar with these processes, and maybe that's a benefit that I have not recognized, maybe. But it's never like you miss a payment, bank comes after your home the next day. Like you get such a big period of time, and then for banks to actually recognize that takes a lot of time. For banks to actually state it in their financial results, whether it be quarterly earnings or yearly annual reports, that takes time. It takes time for, you know, annual report, you might have a financial year end of 31st of December. The annual reports don't come out until March or something like that. So there's a lag before the market actually, you know, becomes aware of that. Yep. And then even after that, like it just takes time. Like it takes time for it to hit the mortgage securities. And even before all those things happen, when banks are in serious liquidation or solvency issue under those issues, right now, like the financial landscape has changed so much that they will run straight away towards the Fed Reserve, asking for help, asking for liquidity injection. So like, I think there are more, I guess, reasons why the crash will be delayed this time around, just because of the relationship that the commercial banks have with the reserve banks or the central banks. I think there will just be even more reasons why the action will be delayed this time around, rather than the other way around, an immediate crash. So that's my thoughts.
And the reason I talk about this, and the reason I ask, is because a lot of people will see these, they probably don't know what they mean, but there's trigger points like the 10 and 2-year yield, they'll invert and then they go crazy and stuff. And the reason I think it's so important is because what can happen in 3 years, if they're off by just a year or 2 or 3, if they're off that much, you could see 10 or 20 time gains in your stocks.
Yeah. 100%.
So, I mean, when they say, oh, well, it's coming, you know, it could be coming a year from now, I better prepare. It's like, you could see a 5 or 10 bagger in that year on a blow off top. I mean, it could be like portfolio life-changing gains in that small little period, because what happens before the crash? Usually blow off tops.
Yes, 100%. And especially in commodities. So, okay, so this is it. So this is a classic example, right? So we're talking about uranium. That's probably the sector that I like the most. But it first inverted in 2006. When did the blow off top in uranium come? 2007. So if you sold out based on yield inversion back in 2006, you would have missed out. So 2006 was when the yield inverted. You would have missed out on this early gain.
I know, you'd have been sitting on the bench while the World Series was playing because you were too afraid to play.
Even if you had your money in one of the largest commodities player, so Rio Tinto, for example, 2006 is here, right? So you could have at least doubled your money, like playing in these safe commodities. If you had it in the largest iron ore player back in 2006, in Australia anyway. So this was 2006. Oh, yield inversion, everything's going to crash. If you sold it here, that's 60 cents right there. Yep, you missed out on a 20 bagger, 20 to 30 bagger.
Yeah.
So,
like
that's why. Yeah, that's why it's so important to understand that everything takes time. Like I think it might have been Ray Dalio or something. Like one of the biggest lessons that he's learned was everything takes much more time than he ever anticipates. So Everything takes time.
Yeah, I talk a lot about time frame, investors' time frame on
Yeah.
on the channel a lot too, because almost everyone's time frame is too short. I'm like, you got to go big picture, you got to go big, you got to wait, you got to be patient. It's a big, long, boring plane ride that you got to ride through. And some of these companies that are junior mining companies, like their entire bull market was when the inverted yield curve happened and before the crash. Like their entire move happened in that time period, and you would have missed the entire thing. So
exactly right. Let's look at Bannerman.
Yeah, like some of these little
2006 is when the yield inverted. So you would have missed out on this. A 40 bagger.
What was it?
Hold on, let's just do a quick forecast. Hold on. So 2006, this is when the yield inverted. Yeah, you would have missed out on 55 bagger. So
55 bagger. You would have missed the entire uranium bull market for Bannerman.
Entire uranium bull market based on yield inverting, selling out and yield inversion. And you've talked about this, Andy. Like it's not when the yield inverts, it's when it shoots back up. When it's the shooting up of your yield curve after an inversion that there is a crash.
So you know what that means, though, right? What that means, it's basically saying that we have inflation in the system. They usually invert or wants to invert or goes flat. That is signaling that you've got inflation in the system, and people don't want to hold bonds. So they start selling their bonds, especially the short end.
Yeah.
And then the long end will eventually move around, hopefully.
Yeah.
But it all depends on how long they think that inflation is going to last. So the yield curve inverting is basically going to happen. It has to happen. It's part of the cycle and the process. So, I mean, all of these metrics are going to go red because at some point we are going to crash, and that crash is going to happen after the liquidity stops entering the system.
Yeah.
So, I mean, you have to, I guess, know this. I mean, everyone gets so afraid, and I'm just like, guys, this is nothing. I don't know. I don't know. Maybe just because I know about it, and I don't know. It's just difficult to.
Well, maybe I don't know, but I clearly don't see it. I mean, maybe I'm missing something. I don't know, but I just don't see it. And this is what we're talking about, right? So yield inversion happens, and then it's when it shoots up like that, then you've got to worry about recession. I mean, that's what history is showing, right? And more important than yield inversion is what you've talked about before, Andy, which is are we seeing big money pile into bonds? Are they afraid of a market crash, piling into bonds? Clearly, they're running away from bonds right now, right? So I just don't see it. So these gray lines are like, period of recessions, right? So yield inverts, shoots up, and then after it shoots up, there's a recession, right? So it happens every time. It's not while it's inverting, it's while it's shooting back up. So I don't know. I just don't see it.
Yeah,
I don't see it, Andy.
Another thing is we want yields to go up. We want that to happen because that is our driver of money coming out of the system. That's our fuel.
Yeah.
We need that to happen. We don't want the Fed to reverse course. Well, I don't know if it'll matter because I think what they're going to do is that they're going to have to buy the bonds themselves, and that money's going to come over anyway. But it's in motion. Like the trend is in motion right now. Like this should be the time where you're the most bullish, not the least bullish.
Yeah,
in my opinion.
That's what I'm feeling right now.
So, what opportunities what sectors are you looking at? What opportunities are out there? You don't have to share specific names, and that's fine. But what sectors do you really like and why?
So, the sector that we've been talking about, that you introduced me to, which is dry bulk shipping. So the reason why I really like dry bulk shipping. So I'll just talk about a name that I haven't got on my list, but this is probably your biggest, one of the biggest dry bulk shippers out there. And what you're seeing is very similar to your uranium chart, in the sense that this is a monthly chart. In the sense that you've got a double bottom here, you've retested the neckline, and then now you're launching again. And these, the beautiful thing about these are, if I just put in the key indicators like market capitalization, And I'll just put some earnings in here as well, because the valuation of these companies are almost unbelievable. So net income, look at net income, revenue. Oops. So if you put in some of these key measures here, so market capitalization of, I don't have this stock, but market capitalization of Golden Ocean Group Limited, and this is not financial advice, but it's $2.8 billion, yet they've made $400 million in total revenue last quarter, $200 million in net income, which means basically annualized, they're making $800 million a year, yet it's only trading at 2.8 market cap.
Ridiculous. It's ridiculous.
So just slightly over 3 times earnings.
And look at the look at the volume on that stock too. It's just like
I know.
the people, like people are piling into it.
Yep. That's
and the
right.
whole
That's right.
sector
And if you look,
oh God, it's good.
yeah, and if you look at other names, I don't have this one either, but Safe Bulk is, I think, another one, another dry bulk. So once again, very similar looking chart. So you've got a double bottom, you've come up, you're retesting this zone, and similar kind of like your fundamentals are really strong for this company as well. So if you're looking at $500 million in market cap, and they made $65 million last quarter. So annualize again, that's 240. So they're trading at like 2 PE ratio. So and trend is just turning around. That's the thing.
I know.
It's just turning around.
These
so
are like,
they've made.
Oops. I was going to say, these are ultra value, right? I mean, this is, how are they this cheap? I don't get it. It doesn't make sense to me.
I just don't know. I don't know. It doesn't make sense. Doesn't make sense. I think another one was like Star Bulk or something like that. So I'm just looking at all the dry bulk shipping companies, the larger ones that I don't have myself. But yeah, once again, this is a very bullish looking chart. So you've got the double bottom here happening. You didn't even come down to retest. You're just launching higher with this. So you've got $3 billion in market cap and $300 million in net income last quarter. So
no, it's awesome.
Once again, like
awesome.
Yeah, I've never seen valuations like this in any sector, to be honest. In terms of like cash generating business like this, they're generating so much cash for their market cap.
I know. The price to sales is just, or price to income ratio, I guess, is just ridiculous. Yeah. It's absolutely numbing. Like I look at this and I'm like, how come we're not buying, a bunch of this? And then you get like a sell-off today or whatever, and people are afraid, and it's like, how are you afraid of this? These guys are raking in cash. Like this is like the best model you can think of.
I know. And I haven't got this either, but I need to get my hands on this, I think. But I just haven't seen the general shipping sector turn around. So I've seen, dry bulk sector turn around, and dry bulk obviously has that seasonality. But with Zim, for example, this is like one of the biggest shipping services company. Net income, 1.7 billion. They're growing, right? 1.7 billion last quarter in net income, and they're trading at 5.5 billion market cap. Like that's like less than 1 PE, I think.
Yeah, pretty much.
I'm just like, I think they pay 30% dividend. 30% dividend. So you put $100,000 just in dividend, you get 30,000 back. So I don't know. I need to get some of these, but I haven't yet. I'm just waiting for the markets to turn around a little bit. But what I do see here is potentially like a huge bullish cylinder. And what I hope to see is maybe do this for a bit. So basically form some triangular type of pattern where it consolidates for a while. And maybe, when it's getting close to a breakout, maybe I'll get in then. Maybe I'll try, maybe I'm playing too cute and trying to time this, but I don't normally see a huge bounce straight away with these type of patterns. So I think I might just wait to see a little bit more of consolidation, a little bit more of tightening. And then maybe I'll enter it then. And especially if it kind of times with the next run in the uranium, maybe I can rotate some of the profits into this. It's kind of what I'm thinking. So yeah, there are just so many good opportunities right now. And
so you like shipping then? That's kind of your favorite.
I like shipping.
Okay.
Yeah.
And that's the Baltic Dry Index.
Uranium. Yeah, along with uranium, because I don't want to discount how much I like uranium as well. But this is something that I had posted earlier, just around seasonality of dry bulk. And yeah, so it's almost perfect. So with dry bulk, usually what happens is it sells off from between like October to March, and then it tends to pick up again. So these lines here is every March of every year. So what you'll see is from here, like it turns around this time, turns around, turns around, turns around, you know, it turns around. Obviously there was a sell, but it turned around before it sold off, turns around, turns around. So I feel like this is such a consistent seasonality within the shipping sector that you don't really see anywhere else. I certainly haven't seen this anywhere else.
I like the rounding
it's just
bottom.
so consistent.
It's good.
Yeah. Rounding bottom.
There it is.
Especially, so this I just haven't seen anywhere else. And my brother-in-law is actually in like logistics, and he works with a lot of the shipping companies. And what he did mention was that typically what happens in shipping is that everyone wants their stuff before Christmas break and the new year, which is why I think we see a huge run up to October to have everything delivered by then. And obviously your rates follow the demand for shipping. And then it gets a little bit quiet during the Christmas period, like November, December to January, and perhaps like February. It's a little bit of a quiet period, which is why I think we're seeing this type of trends or the seasonality play out in BDI. So I think, and it lines right now, like my entry into BDI, so a couple of shipping companies I made recently was one of the factors was seasonality, because I'm thinking, okay, it's kind of happened every single year since 2006. So I've got no reason to believe that it won't happen this year. Right. So that's why I kind of, dabbled into a little bit of shipping company over the last few weeks. I think the fundamentals are just incredible. Like these stocks that are trading at like 33% of sales, for example, like 1/3 of sales, annual sales, and trading at 1 PE. Like I've just never seen valuations like that. A lot of these names are also trading at less than less than the book value, right? The value of their vessels together with cash holdings that they've got. So I've just never seen like valuations like this. So I just had to get some.
Yeah, I'm the same way. Yeah. So what we can end it there, since that's kind of a good stopping point. Maybe we'll talk about something else later, some other time. But thanks for coming on, Scott. I really appreciate it. And you got everyone who's watching, you should definitely check out his channel, Sow and Reap Capital, that we had in the beginning there. Become a subscriber to his channel if you like what he's doing, and definitely follow him. So thanks for coming on, Scott. I appreciate it.
Thank you. Can I just quickly share verse from the Bible?
Sure.
Yeah. So what the Bible says is God is love. So yeah, I mean, that just speaks for who God is and how much he loves us. So yeah, I mean, very quick share, but that's all I wanted to share for today. God is love.
Okay. Well, that's all I've got. Anything else, Scott?
No, that's it. Thank you very much for having me on.
All right. We'll catch you later, Scott. Thank you.
Thank you. Bye.